Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday, the 20th of September 2020, and yesterday we published our Gold and Silver Weekly Update for the week ending the 18th of September, and have placed a link to this podcast in the description box below. Now, in that video podcast, we learned that gold rose $9 last week from $1,941 to $1,950. having hit a high of 1,973 and a low of 1,933, a rise of 0.5%. The highest level gold has ever been in US dollar terms was $2,067 on Thursday the 6th of August of this year. Now, many are now wondering, where will prices move from here? And what about those heralding $3,000 gold, $5,000 gold, $10,000 gold anytime soon? Well, we thought today, as it's Sunday, and normally a day of relaxation, we would feed the appetite of those who relish such prices and genuinely believe that reaching these levels, and soon, are a distinct possibility. Now, we've already stated our position that we do not expect to see gold rise above $2,300 this year. But having said that, we do have some sympathy with the author we're about to quote to you, who takes a slightly differing view. So, let's take a look at a recently published article that may indeed feed your gold porn desires. Article on mankni.com, originally dated September 1st, 2020. Gold $3,000 to $5,000 possible by 2022. Here's why. The internet is filled with predictions for the price of gold from $500 to $50,000 per ounce. It depends on your worldview. I suggest 3 simple scenarios. Scenario 1. Status quo. The next 5 years could look much like the last 20 to 40 years. Politicians spend too much money, debt expands exponentially, central banks monetize debt and desperately inflate and reflate bubbles to maintain their power and continue the transfer of wealth from the many to the few. This is status quo, or more of the same, and indicates that gold prices will rise substantially, but not in a hyperinflation. Scenario 2. Deflationary crash. Deflationary forces overwhelm the financial system, and central bankers and politicians can't or won't reverse those deflationary forces. In that scenario, most paper assets crash, while the purchasing power of gold increases far more. Central bankers will do almost anything to avoid this scenario. And scenario 3. Deflation and hyperinflation. Deflationary forces temporarily crash the financial system, and eventually central bankers and governments inflate currencies, possibly to hyperinflationary levels in their heavy-handed reaction. In this scenario, gold prices will go to the stratosphere, perhaps $5,000 or $50,000 plus per ounce. The ultimate gold price in a hyperinflationary scenario is unpredictable, since hyperinflationary forces feed upon themselves and destroy purchasing power unpredictably. Gold reached nearly 100 trillion Weimar marks per ounce in 1923. Gold, if currently priced in 1945 pre-devaluation Argentina pesos, would be over 10,000 trillion 1945 pesos. Hyperinflation is an ugly, destructive and unpredictable process, even for a reserve currency. In scenario 1, more of the same, we can reasonably expect Politicians and central bankers will manage the crisis of 2016-17 as they have most other crises, such as 87, 98, 2000, 2008, by increasing spending, addressing an excess debt problem with even more debt, and pumping more funny money into the global financial system. 1. Official US national debt increases more rapidly than its typical 9% per year compounded rate, perhaps 10 to 12% per year. 2. Dollars, euros, yen and other currencies devalue against each other and against real assets. In other words, currency wars. 3. Stock markets collapse further and then, buoyed by central bank printing and currency devaluations, will rise. 4. Depressed commodity prices will move much higher as currency devaluations are aggressively pursued by central banks. And 5. People and investors eventually realize that currencies are devaluing and they must avoid overvalued bonds, negative interest rates, crashing stock markets, and paper promises to preserve their savings. Gold prices will rally much higher based on increased investor demand in a supply-constrained market. Given the above status quo scenario, the valuation model I described in my book, Gold Value and Gold Prices from 1971 to 2021, is relevant. The model is based on 3 variables: the official US national debt, the price of crude oil, and the S&P 500 index. I used prices smoothed with moving averages since 1971 to define the basic trend of gold prices. The correlation of the calculated gold using smooth prices with the actual smooth annual prices was about 0.98 since 1971. This valuation model works well within a broad range of economic conditions, including stock and bond bull markets, bear markets, crude oil bubbles and crashes, various forms of quantitative easing, Democratic and Republican presidents, wars, and occasional peace. Using status quo assumptions for future increases in official national debt and crude oil and a collapsing S&P 500 index, I created the following graph of calculated gold for the next several years. And as you can see, Gary Christensen, who's produced this, has predicted that gold will be up well over 3,500, I think here, by January 2021, or well over 3,000, sorry, by January 2021. This was actually produced in 2016. Okay. This, let's shrink it slightly. This is a model based on reasonable assumptions, but there is no guarantee those assumptions will be fulfilled. Strange and unexpected events have unfolded in the past decade. Examples: in 2007, few expected the S&P 500 to fall below 700. Who expected 7 years of essentially zero interest rates in the United States after the 2008 crisis? 3 years ago, who would have predicted that in excess of $7 trillion in sovereign debt in 2016 would yield negative interest? Who in 2013 would have predicted sub-$30 crude oil? My point is, 1. Strange and unpredictable events occur in a central banker-controlled world dominated by overwhelming debt. 2. Secondary and tertiary consequences of stupidity, wars, QE, ZERP, and negative interest rates are difficult to predict. 3. A deflationary collapse and hyperinflation are perhaps as likely as the 4 strange and unexpected examples above. 4. Gold prices in a deflationary collapse or hyperinflationary blow-off are difficult to imagine. And 5. The more likely expectation, in my opinion, is a continuation of the status quo financial conditions we've experienced since 1971. The model suggests that a reasonable status quo valuation for gold in 2021 is around $3,000. Prices will fall below and occasionally spike much higher than the valuation, so a gold price of $5,000 in 2020 to 2022 is plausible. The above is not a prediction. It's based on the observation that central banks devalue their currencies, governments spend to excess, and those actions affect the prices for crude oil, stocks, commodities, and gold. Conclusions. How crazy will it get? The future price of gold is very much dependent upon the reactions of governments and central banks regarding the current deflationary forces. Status quo response $3,000 to $5,000 per ounce is quite possible at some time in 2020 to 2022, if not sooner. Deflationary crash response. Gold was substantially increasing purchasing power, but its price in dollars, euros, yen, etc. is difficult to estimate depending upon the economic damage that occurs. And the hyperinflationary response. The price of gold will be unbelievably high. Well, admittedly a long article, but one which paints a number of interesting and not totally outlandish scenarios. Now, we have stated for some time that we expect the 2020s to be the decade for precious metal prices, and whilst we do not, frankly, envisage seeing $50,000 gold in our lifetime, save a complete currency collapse, which means $50,000 may be worth the equivalent of $5,000 today, we do envisage gold rising to $3,000 between 2021 and 2022, and a potential for a rise perhaps moving closer towards 2024 to 2025 of $5,000. Will we be right? Or will this happen much sooner? Well, only time will tell. But having said that, we most certainly do not rule out the prospect, as raised by the author, whose article we've just read, of higher prices sooner, and wonder what your views are on this very emotive and exhilarating subject. Do share your thoughts. Meanwhile, thank you so much for listening, and if you haven't already done so, please subscribe to our channel, press the bell sign so you're notified of our videos as and when they are published, and enjoy the remainder of your weekend. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.